Hey Finance fam, welcome back to my channel. I think you're going to like this video today. I'm going to talk about 3 tips that'll help you with allocating your money in your investment portfolio. So I love investing. It's my favorite topic. You guys know this. And taxes are my favorite topic too. But investing wins. And I wanted to give you guys some information that'll help you when you go to be a do-it-yourself investor and you're trying to, even if you're not a do-it-yourself investor and you have somebody helping manage your money for you and invest your money, I think that these are going to be good tips to have in your toolkit no matter what your situation is. And that way, if you are not managing your own portfolio and someone's doing it for you, you can kind of check their work and look at what they're doing and make sure that everything is a-okay. The very first thing that we need to do when it comes to investment portfolio construction is break down the difference between passive investing and active investing. And this will make a lot more sense once I actually get into this video. But passive investing is essentially investing your money in funds. Funds are easy diversification done for you by just buying one fund that owns a bunch of different stocks within that fund. And so that would be an ETF, an exchange traded fund, or a mutual fund. And these funds are typically going to be bought and they're going to be held. You're typically not going to be trying to trade in and out of funds. You want to buy them, hold them, have dividends reinvesting for the long run and compound your money. So that's passive investing. Most people that invest in 401ks or IRAs at work, they are most likely investing passively via some type of fund. Active investing is where you actually pick stocks. You are researching stocks, or it doesn't even have to be stocks. It can be you're picking certain cryptocurrencies or REITs or whatever it is, right? And you are actively selecting different assets based on how, in terms of stocks, how the company is doing financially, how the company is growing revenues, things like that. So that is where you're doing your stock picking in individual names. So that is the difference between passive investing and active investing. Most people are passive investors, but there is a large percentage of the population that does enjoy picking stocks in their portfolio and investing actively as well. So I'm one of those people that does both, and we're going to talk about that a little bit later. So the first tip that I want to discuss with you is position sizing, how you need to be mindful of position sizing and how position sizing is different between someone investing passively in funds versus actively in stocks. So position sizing is something where you are looking at how much money you have to invest, and you are essentially choosing what percentage of your portfolio do you want to invest in a certain asset. And a lot of people, they are passively investing in funds and they may diversify across a few funds. You may not need a large number of funds to be diversified across mutual funds or ETFs. So it's very common in a passive portfolio to have larger percentage allocations to just one thing. You may have a 30 or 40% allocation to a domestic S&P 500 index fund, right? That's a pretty big allocation, and not really in the terms of passive investing. It's actually not. And I'm going to pull up an example to kind of show you. For active investing, anything 10% or more of your portfolio to be somewhat of a larger position if it's an active portfolio where you're picking individual names and you're not managing through funds. So if you're a stock picker or a crypto picker or whatever it is, and you are trying to construct a portfolio, you want to consider anything 10% or more for things like high risk assets, like commodities are higher risk assets, right? You can even consider certain real estate investment trusts to be higher risk, certain tech stocks that have a lot of volatility in them, that would be higher risk. Those types of positions, anything over 10% can really start to have an effect on your portfolio. And so you have to be mindful of that when you are constructing, and you don't want one single position to get too big in your portfolio, because you don't want one thing to ruin your whole entire portfolio. That's why we diversify in the first place, and we're mindful of position sizing so that one thing can't take us out. So I'm going to move over to common stock, because common stock is actually a platform where traders and investors go and they can connect their actual brokerage accounts, like from whatever brokerage you may have, you can connect it and you can actually see other people's portfolios. So I thought that this would actually be a really good way to show how people that are on their leaderboards are positioning their portfolios. This is all like public stuff. You could just go look at it just to see what other people are doing. Obviously, it's not investment advice, but you can just get a feel for how people are positioning. And I came across a few portfolios in the leaderboard that I found quite interesting to prove this point. So this portfolio here from this user, if I scroll down here, you can see the entire portfolio. What you'll notice, the first thing is going to be a allocation to SPY, which is an ETF that tracks the S&P 500 index, and he's got a 35% allocation to this ETF. Now, you probably are thinking, oh, well, you said anything over 10% is high. But remember, I said that's in an active portfolio with individual stocks. When we're talking about allocating passively to ETFs or mutual funds, it's very common to have a larger allocation to a mutual fund or ETF because that's just the nature of the beast. It's a diversified fund, and you can have a higher allocation in that case, okay? But you'll also notice that this person has individual stock positions as well. Sometimes certain positions can become very large, especially if they have been appreciating over time. So I've actually personally got a position in Square. I have a really low cost basis in Square in my active portfolio, and it has grown over time and it's become way over 10% of my portfolio. At one point, it was 20% of my portfolio. So, what did I do? I sold off some of the stock that I had to kind of get that allocation a little lower. And I took that capital from the Square position and I allocated it to other things. So that's really called rebalancing. So that's what you can do if a stock position gets a little too large for your comfort level. Now, with something like Apple, Apple is an amazing company. It pays a really great dividend. And this is where active investing can be very subjective, and it just kind of depends on your risk tolerance and it depends on the actual stock that you are investing in. But like Apple has a 16% allocation in this portfolio, and that's rather high for an individual name because if something bad happens with Apple and the stock sells off a lot, like that's going to put some weight on your portfolio. That's going to have an impact. So, this person could have been in Apple for a long time and maybe they've got maybe they plan to rebalance out of it and take that profit and put it elsewhere. But this is definitely when you start to kind of look at positions like this and even Google and say, okay, yeah, these have appreciated a lot. These have become a large percentage of my portfolio. Is there a better place to put this capital? Maybe there isn't. Maybe you want to take on that risk and have that larger position in that individual stock. That's called a concentrated portfolio. And sometimes hedge fund managers literally invest that specific way. They are trying to have a concentrated portfolio of individual stocks that they really, really like, they really see a bright future for, and they want to have a big allocation because that's going to be bigger reward, right? So just keep that in mind, but that also leads to bigger swings in the portfolio, bigger risk, because you are more allocated. So, it's really not a right or wrong. I just want to give a rule of thumb that, anything over 10%, a position that gets over 10%, that's an individual stock. You want to kind of think about those things. You want to think about, well, what is this company? What are the risks here? Am I okay with holding a larger position in it? Why? And that's how you kind of have to analyze. But everything going forward, he's got a mix of actually funds and individual stocks, which is called a core and satellite strategy, which I actually love that strategy. It's my favorite strategy. I utilize it myself. I've got a passive portfolio and an active portfolio of individual stocks. So, I totally am cool with that. So I like what this person has done in general with having the ETFs, having the individual stock positions, but the larger percentage positions are high quality names. And obviously, I don't know this person or their situation or why they invested this way, but I like that this person, even if they're going to have a high allocation in their portfolio, I like that it's these quality stocks like Apple and Google. So let's look at one more. Let's look at this portfolio here. And this one is a portfolio of, there is an ETF in here. ARC Investment Management is an ETF, but these are individual stocks. So, like the top holdings, it looks like are a few individual stocks, an ETF, and then some more individual stocks. Now, look at how this person has allocated. They actually have allocated, they've got their largest position is 10% of their portfolio, and everything else doesn't go over 10%. Everything else is, this is kind of how my portfolio looks. My square position in my active portfolio is going to be the largest, and it just kind of continues to grow over the years, and I've been able to rebalance out. But mine looks very similar. A lot of my positions that are my core positions are going to be anywhere from 8 to 10%. And then I have a lot of positions that are like 5% less. And so if I feel compelled to add to those positions over time, I do. But this is definitely, if you're going to have a portfolio of individual stocks, obviously this person has an ETF in there, but still, that's fine. That's totally fine. I do the same thing. But the way that they've allocated, it's not like one single position is going to take them out. And so that's what I really liked about this. So those were just some, allocation examples that I thought kind of were in alignment with what I was discussing. Now, if you haven't already gone to Common Stock, follow me. Go to shetalksfinance.com/common stock and follow me, create a profile, and let's be friends. And I post a lot of different types of insights on common stock. So definitely go check it out. Okay, so the second tip that I have for portfolio construction is going to be diversifying across the different sectors of the market. Now, you can also throw in, some cryptocurrency in here. That's more so across asset classes, but mainly what I'm talking about here is the sectors of the stock market. So there are 11 major sectors in the stock market. Pulled over to YCharts, they have a pretty good overview here of the different sectors of the stock market, the market caps, and I absolutely love how they have the PE ratios here, so you can kind of see which sectors are showing more value versus others. Obviously, the tech sector likes to hold the highest valuation multiple. That's been pretty common. And so I like the idea of, when I'm constructing a portfolio, of having exposure to all or most of these sectors, right? I like the S&P 500 in terms of passive investing, the S&P 500 index funds. I personally like funds that are tilted more towards S&P 500 over the NASDAQ, for the simple reason that the S&P 500 has more diversification within it. The NASDAQ is very tech heavy. Okay. The S&P 500, you'll find things like energy stocks. You'll find things like industrials. So I like that about it. Essentially, if you're looking at your portfolio and every single stock or every single ETF that you have has you exposed to technology or has you exposed only to energy, that's going to not be the diversification that you want. And we're seeing that now with, oil stocks, energy stocks are doing really, really well. And technology stocks have been taking a huge hit. So, the tables always turn eventually. That's why we have market cycles. We have ups and downs. So I think it's really important to take a look at the stocks that you have in your portfolio or the funds that you have in your portfolio and make sure that you're not too overexposed to just one thing. Too much of one thing is not a good thing. Now, if we're talking desserts, maybe that's not true. Too much dessert is never a bad thing. But, you get what I'm saying. All right, let's talk about cash position strategies. This is a tip that I'm going to give you in relation to portfolio construction, because cash is a position too, okay? Cash is important, right? And you want to make sure that however you're managing your portfolio, whether you're managing passively in funds or actively in individual stocks or both, you want to know what to do with cash as it comes into the portfolio and how to manage it properly, right? Cash is an allocation in certain portfolios that you definitely have to manage. So in a passive portfolio invested in funds, you don't want cash lying around in a passive portfolio. The point is, You are investing passively in funds as cash comes in. You want it invested, you want it compounding, you want it earning dividends, and you want it working. So if you are only investing passively, this is essentially how like a 401k works, right? You are constantly contributing to a 401k through your paycheck, or maybe if you are self-employed and you have a solo 401k and you're contributing annually, you essentially are putting money in from your paycheck every single week or 2 weeks or month, and that money is immediately going and it's being invested. Okay, you're never really holding cash in a passive portfolio. Now, active investing is a completely different beast. With active investing, meaning you're picking stocks, okay, that is going to be a much differently managed cash position. You may have cash positions that increase as you take profits on stocks. You may have cash positions decreasing as you deploy capital into opportunities. I personally love the idea in an active portfolio of always having some type of cash position, because guess what? We have earnings every single quarter, and there's usually something that, comes up as an opportunity as news comes out. Maybe earnings weren't as good and maybe the company is going through some issues, but those are some of the times where I actually find the best opportunities is during crisis or during issues that companies are having. If it's fundamentally still a great company, but it's just a short-term problem, then I want cash to be able to buy that up. And unfortunately, it's really hard to predict when these opportunities will come, which is why in my active stock picking portfolio, I prefer to always have a cash position on hand of some kind. Not, depending on the market environment, it may not be a lot. It might just be, I don't know, 3 or 4% of my portfolio. Sometimes it can be more. Sometimes it can be over 10%. So that is just how I personally have managed my cash positions. And it also obviously will depend on the opportunities, how stocks in the portfolio have moved. If you're trying to take profits and harvest cash for other opportunities, that's the whole point of an active portfolio. It's active. All right. So to recap, the 3 tips for investment portfolio allocation. The first one is going to be position sizes matter. Okay. So go in, look at how you're allocated in your portfolio. Are you too overly allocated to one thing that could potentially take you out if you're individually stock picking? And remember, if you are investing in funds, it's very common to have larger position sizes for those funds. That's just the nature of passive investing. So don't worry about that as much. Second tip, diversify across sectors. Remember, things have their times in the sun at different times during different market cycles. So being diversified across different sectors, whether you're investing individually in stocks or you're investing passively in funds, you still want to consider this either way. The third tip, cash is a position too, and you should manage it properly based on the type of investing that you're doing. If you're investing passively in funds, you want to make sure that your cash is always invested and always working, okay? And then if you are investing actively and picking individual names, then you are going to have a more dynamic cash position depending on the market environment, depending on the opportunities that are out there, depending on how your stocks in the portfolio have done, and if they've had profits that you can harvest for other opportunities and rebalance. So, cash positions in an active portfolio are going to don't be afraid to hold some cash in an active portfolio for opportunities. I personally think that there's always something that eventually comes along, and you don't want to be in a position in your active portfolio where you can't take advantage of it because you don't have any cash at all. So I wouldn't say that holding cash in an active portfolio is necessarily a bad thing. All right, finance fam, that's it. Those are my 3 tips for portfolio construction. I hope that they helped you out a little bit. Don't forget to go to shetalksfinance.com/common stock, set up a profile, and follow me at shetalksfinance. We'll chat these markets there. Don't forget to like this video, smash the like button, subscribe to my channel for more finance content, and then I'll see you guys next time.